discuss the same, we have Rahul Jain, Director Research at Dolat Capital, joining us. And Rahul, hi, morning. Thanks so much for joining us on the show. We've seen Nifty IT outperforming the rest of the market this month. Help us understand what's driving this sudden strength. Is it just pure sector rotation? Is it the churn that we're seeing? Or do you believe fundamentally this has merit in terms of the way Nifty IT has been outperforming?
Yeah, I mean, part of this could be related to the kind of correction that we saw in the Feb-March period when the expectation for the sector in terms of growth and earnings were much higher, and subsequently the valuation corrected. And when the earnings started, we got a mixed set of commentary where some companies saw a lot of impact related to the macro or the tariff kind of a thing, while many other companies said that they have seen very limited observation in terms of any deterioration related to that. And since then, the earnings 1.5, 2 months have gone, and we have not seen any further deterioration. Rather, on tariff side, there is a lot of normalization that has happened with many countries. So there is some bit of ambiguity that will come into play as tariff eventually come into picture. But for now, no bad news has been acted as a good news in the space. Valuations were low, growth expectations are low, and valuation can see those some room for upside if the growth eventually improves. So, market is anticipating that as the year progresses and there's no incremental bad news that will shape up in the sector, the growth assumption in the sector will eventually improve and will drive the valuation. So that is something which is finding value in this space at this point, and that should continue as the year progresses.
Right, but the valuation comfort is still there, Rahul. But also give us some sense that how is the deal momentum picking up? Anything incremental that you're picking up right now? Because back in the earnings season, we have seen quite a mixed commentary coming in, especially with respect to the discretionary spending in US. So off late, has anything changed in terms of the pickup over there?
Yeah, I mean, we do keep getting those press releases by the respective companies where they announce important deals once in a while. So that is a usual activity, but we don't hear from our recent interaction with companies where they are seeing the stalling of the ramp up. I think stalling of the ramp up has been a bigger pain point in the last 2 years, more than the deal gaps itself. I do agree that deal win momentum is quite mixed across players and it's not very uniform. But we could also see that there was a lot of ambiguity in the mind of the spenders also in that period. Now, those things getting streamlined to some degree and may happen more in Q1 as tariff eventually takes into action. Then probably there could be an opportunity of a pent-up demand coming starting from Q2, Q3 onwards. There's also one very big trend on the Gen AI side where the adoption is coming closer on the timeline point of view, which itself could also be another round of trigger for tier one vendors to begin with in India. So those are the two triggers in pending, whether they happen after Q1, whether they happen later in the year, that is something we need to work on. But so far, with the expectation into play, so far giving the opportunity that is available to us, I think we are in the bottom part of it, and we would only see things improving here.
But Rahul, what's your sense on how much the AI disruption is already in the price, or how much of it is, yet to be seen because it's such a evolving landscape out there?
Yeah, I mean, very difficult to measure it in a very precise manner. But I'm just going by the past cycle of various technology trend that has always been perceived as a risk to the sector. So we have seen that when there was too much talk around blockchain, digital, or many other technology trend, what eventually happened is that whenever these technology trends are in the early stage of adoption, there is a lot of boutique companies which play a role, which are very tech savvy, very individual-led, smaller setup, doing pilots for a lot of companies. But once these enterprises, the global enterprises, decided that, okay, yes, we need to do a mass rollout, we want to scale this technology enterprise-wide, then their key support vendor are the same top 10 companies, right? So when the mass deployment of those technology has to happen, they rely eventually on the likes of Accenture, TCS, Infosys, and the like. So I think that is what will happen with AI also eventually. Are we 6 months away from that trend? Are we 1 year away from the trend? We don't know. But most smartest people on the pro AI side talks about that we will see mega adoption within 12 to 24 months. So some of that early trend should happen in the next 6 months, and it may scale up 18 months from now based on those understanding. But it's very difficult for any one of us to single it out that this is when it will take a big shape.
Rahul, point taken. But even when we are talking about the entire outperformance in the Nifty IT space, there's one basket in particular that's Midcap IT, and that was a buzz even yesterday. And overall, also Midcap IT has outperformed the overall basket. Do you still see valuation comfort over here? And if you had to place your bets in the entire IT space, would the midcaps be making it to your radar?
Yeah, I think the whole logic of why IT midcap has been doing so well for so long over tier one names is the sheer difference in growth rate of these companies. And these companies are growing anywhere between 12 to 18% on an organic basis, and in some cases there is an organic element as well. And while the large cap are at a very reasonable valuation, their growth in last 3, 5 years, except for 1 year in between because of the COVID led, if you look at their 10-year CAGR in that, high single digit to mid single digit basis. So for a lot of companies, the filtration of investment would only come if the growth can compound in early double digit at least. And that is the reason people are seeing more value in stories that can become large and can grow faster. So the likes of Persistent, Coforge, KPITs, which are reasonable in terms of size with close to $500 million to $2 billion revenue band. So they are behaving like a larger mid cap, I would say. So they are not mid cap or tier two as such. They are good in size in their own, and where there's a lot of money can be deployed. So those are the areas where people are parking money because of the growth rate differential. Over a period of time, once the growth differential also narrow, the valuation differential will also narrow. So that is something we are waiting for. Once we see a better IT cycle, the growth differential will narrow. In a troubled environment that we have seen in the last 2.5 years, I think companies with much higher execution prowess and much smaller size becomes an advantage. And that is what we have seen in some companies, while the large cap do take a hit because of the macro spending factors and all. So that possibly explain in our view that why that differentiation has happened.
Right. Rahul, would you elaborate on that? What's your pecking order in terms of your preferred list from within IT?
So there are 3, 4 names which we are liking, and these have a lot of short-term as well as long-term reasoning behind. So within the larger caps, we've been liking LTIM, this one name where the order book growth has been decent on the closing basis of FY25. And there is a CEO change, which can probably bring in some kind of stability on the top layer, which has seen some attrition in the last 12, 18 months. So that is something which we are liking, and the companies historically pre-COVID also have been doing better in terms of growth versus the tier one peer. So it's one where a large business which can do well and is reporting below its potential for last 2, 3 years. So there's a lot of time, good potential for it to do better from here on. So that's one large cap name that we like. We also like HCL Tech given its consistency, decent, confident outlook for this year. And we also see potential for Infosys to gradually scale up its guidance later in the year. So these are the two, three names that we are liking in the tier one pack. Other company relatively we like less. That's on the large cap side and mid cap side. As you also highlighted, some of the good businesses are very expensively priced. So leaving them aside, what we like right now is Emphasis, KPIT, eClerx. So these are some of the names where we are seeing that growth versus valuation provides an opportunity to make money even from this point. So these are the names that we are liking within the mid-tier to small cap bank.
Interesting list there, and that's where outperformance also has been selectively. But good speaking with you, Rahul. Thank you so much for your time today.
Thank you.
Okay, from IT, let's now move to finance.